We've got Gargi Chaudhuri, Chief Investment and Portfolio Strategist Americas at BlackRock, joining in on the show. Gargi, thanks for your time. And, while we're still grappling with this 25% of tariffs, and it still pretty much seems like, it's a work in progress, do you think it's the worst case scenario? And how long would it take for markets to price that in?
Sure thing, and thank you so much for having me. So around the tariff news, and obviously we have another big deadline coming, and I think we're going to get a few more headlines over the next few days and hours. But when we think back to where we were, if we can think back to April, and the huge amount of uncertainty that the market experienced globally back in April, and obviously the massive rebound since, I think it's made a couple of things clear. Number one, equity markets are forward-looking and they like certainty. So even though we don't know the exact level, and we call this the landing zone, globally, we don't know the landing zone of what the effective tariff rate is going to be quite yet. What I think we do know, and the equity market really likes that, what we have certainty about is the floor and the ceiling. And for the India markets, for now, we do have a ceiling, and we think that that's likely to be, it could be 25, it could certainly get negotiated lower. And even globally, we think that we've seen some of the worst of the uncertainty behind us, and now more and more frameworks are coming into place that actually puts forth a little bit, again, of a ceiling, both on uncertainty and on market performance.
Sure. But Gargi, all those concerns regarding, growth, do you think we're headed in for a global growth slowdown?
I think that we have to remember the starting point. And the starting point, if you think back to last year, was a pretty solid one. So globally, we had this backdrop of strong growth. We had central banks that were in easing mode, and some of them still continue to be in easing mode. We had consumption that was very strong. And when we think about certainly in the US, we did see just the GDP out earlier. And we did see some of that unwind from the weakness of the previous quarter, but we are seeing some of the forward-looking indicators softening just a little bit. So I think the starting point from 2024 was a very strong one. And I think it's very fair to expect a little bit of softening from that starting point. What that is different from, and I think that's really important to market participants that are listening right now, is that's a far cry from recessionary levels that we were talking about not 3 months ago. So I think that, yes, there's a softening underway. Certainly when I look at the US and I think about the 3-ish% growth that we came from to sort of a high ones that we might land at for 2025, that is a move in the softening direction. But when I think back to March and April, and many people were calling for a recessionary levels, we're also a far cry away from that. And I think that is what equity markets globally are responding to.
So, Gargi, what is it that we're staring at? Lower equity levels for sure in times to come? Is that what all of this that's happening around tariffs going to culminate into?
I think that there's a very good reason. And again, I'll focus a little bit on the US markets, though the story is very similar for broad developed and emerging markets as well. The focus really should be on 3 things. The first one is extremely solid earnings growth. And one of the things that the equity market is hanging its hat on, the reason that we're at or above all-time highs over the last few months and reaching new highs every single week or month, is because earnings growth is coming through. And especially when you look at some of the largest companies in the world, they are able to grow revenues at double digits. So yes, of course, the equity market is making all-time highs because the revenues as well as the earnings dictate that they do. So that's number one. I think the earnings picture is very solid, especially in large cap US, which is where we're telling our investors to focus on, and we call that focusing on quality. The second part is the point that I made earlier, which is around a move away from this narrative of a recessionary backdrop. We're in an economy that is slowing but still solid, and I think that alongside the fact that labor markets are very, very robust as of right now, and people have jobs, is allowing people to go out and spend. And I think that's the second that is, adding a lot of support to broad risk on sentiment. And then the last theme, and obviously very topical now because we just had the FOMC meeting, even though the FOMC hasn't really done anything so far and they haven't really solidified their action around a rate cut, the next move, more likely than not, is lower. And globally, we're seeing many other central banks lower interest rates as well. And of course, that continues to be a very strong driver, especially if your discounting rate is moving lower. So all of those actually are very good reasons for this risk on sentiment globally to continue.
Gargi, but what happens to money flows? Because, like you said in your note, that there is a profound portfolio shift which is currently underway. Global flows to equities are tracking higher than 2024. But the US exposures are sort of weaning out and they are making up for a smaller share. Do you think money is moving out of the US?
So I think that the profound shift that you're talking about is one that's certainly very top of mind in 2025, which is the first time in several years that at least in the first half of the year, you had that US underperformance versus the rest of the world, whether that be the rest of our developed market peers or some of our emerging market peers. And I think investors, especially US investors, for the first time recognize the home bias in their portfolios. Now, globally, when you look at flows, one of the things that we're finding is non-US investors, so Asian investors, European investors, are recognizing that they too had a lot of US bias in portfolios, which of course makes sense because that has been the outperformer for the last decade. And I think right now, this is a portfolio reallocation decision of moving back or diversifying into home countries which are also seeing earnings growth, which are also continuing to generate very solid performance. So I think this is a portfolio story. This is not an unwind of US exceptionalism story. I think the earnings season in the US is proving to us over and over again that US exceptionalism in large cap quality stocks is very much there. But investors should always be thinking of building a diversified portfolio, which includes their home country as well as sources of alpha from other countries around the world. And I think this is where the international portfolio really matters. And flows have actually painted that picture really well. If you look at global flows, last year about 60% of that went to US, and this year that number is closer to 40. So that allocation shift is taking place, and we think that's a really good portfolio story for all investors everywhere.
Sure. So, Gargi, since you very well highlighted that one must have exposure domestically to one's own country and diversification and the emphasis of that, what's a model portfolio in the current day scenario going to be like? How much to which country?
Yeah, so I'm not going to go into percentages. Obviously, that the starting point really depends on who you are and what you have and what your investment goals are. But what I would say is what we have found just looking at a lot of US advisor portfolios is if you look at a broad benchmark, call it the MSCI ACWI, that has a significant amount of international countries, international equities in there. And most advisors are about 10 to 20% underweight of the MSCI ACWI amount. So that's the starting point, is one of being underweight versus a benchmark. I would say when you're thinking outside of your home country, adding international allocations, whether that be countries like India and China, or whether that be, one of the areas of the market that we've loved for a while is looking at countries like Japan, as well as European financials. We think all of that make a lot of sense. Again, keeping your starting point in mind and recognizing how much how much US you might be having as a starting point. To be clear, this is not a story about wholesale moving away from US large cap. This is a story about adding countries like Japan, countries like India, countries like China into your portfolio in a way that you might not have. And frankly, this is also a story about adding fixed income assets into your portfolio. This is the first time in decades, literally multiple decades, where you've been able to earn 6.5% in international fixed income for US investors without taking too much credit risk. You can really add a diversified source of interest rate and credit and securitized risk to add sort of that very high 6 or 7% yield for being very up in quality. And I think investors should also be focused on fixed income markets alongside a diversified international basket.
Gargi, the other interesting phenomena, which is playing out pretty much across global economies, is sector concentration. It's no more those broadening out days that we had since the COVID recovery was playing out. I mean, look at US. It's all about AI tech. When you talk about India, it's largely financials or infrastructure. Do you think that style of investing is most prudent right now?
I'll comment on the part on the US, where often it's thought of as a bug, but what I think it is a feature. The fact that you're having these AI and tech names, and obviously we're in the middle of earnings season, the fact that these are the largest companies in the world that are able to continue to show that these hundreds of billions of dollars that they have spent in CapEx is now giving them that ROI in terms of revenue, in terms of double-digit growth in revenue. And again, these are multiple billion-dollar revenue companies to begin with. So this is a feature, not a bug. This is, everyone tries to push back on this. Everyone wants to actually see this broadening narrative. Yes, I would say that there is some pockets of broadening that's taking place. If you look even in the US, and much like you mentioned in India, industrials and financials are up double digits, but they're still lagging the communication services and tech sectors, which is where the earnings growth is. And I think to the extent that more and more of all of us are going to be using AI to become more productive, to become more efficient, this is going to actually be something that's going to generate revenue and profitability for many sectors. But for now, this is very much a story about being able to monetize this incredible new technology in some meaningful ways, and it's showing up in earnings.
Where does the dollar come in the picture here, Gargi? Because it's been on a decline. Do you sense that that's a tactical move, or it's more now a structural story, the slip in dollar?
Yeah, so that's certainly the story of, or that was the story of the first half of the year, where you had that significant decline in the dollar. A lot of forces underpinning that. We talked about some of those related to international investors sort of moving away from the US. Certainly, there were concerns around tariffs, certainly concerns around deficits. You've seen that sell-off arrested a little bit. You have seen the dollar, especially over the last few days or weeks, rallying back up. Historically, when you have these large moves in currencies, especially in the dollar, they happen in multiple month or multiple year cycles. They don't really happen in small increments. It happens across 18 to 24 months. I wouldn't be surprised to see the dollar, after this brief sort of rally that we've seen, I wouldn't be surprised to see that continue to move lower. That's another reason that we think that investors should again think about international as a place that can benefit from that weakening USD. Think about areas of even the US markets, which is tech actually, that can benefit from a weaker currency because of the revenues that they get outside of the US. So I think the weaker dollar story certainly taking a breather after the significant weakening we saw in the first half of the year. But I think there could be some more weakening in the quarters ahead, and I think investors should position themselves for that starting now.